Hello, welcome to the Economic View for 2018. I'm joined as usual by Evan Lucas, our market strategist. Hi, Evan.
Happy New Year to you, Tony. How are you?
Yeah, very well. Evan, really want to give the listeners a bird's eye view, I suppose, of what's happening on a macroeconomic level, especially heading into this new part of the year. So there's obviously, if things never stop, and there's plenty to talk about in terms of economic news. So let's just hit it off in terms of what's happening in the US, and then we can get to Australia.
And I'm glad you started at the US, because the US has been, while we've all been having our Christmas pies and Christmas food, it's been a really interesting period. So if you look at what's coming out of there at the moment, it is quite exciting. And the chart that I've got on screen at the moment from Morgan Stanley is a beautiful thing to illustrate probably what 2018 is from a macroeconomics point of view, which is almost, as they describe it, a Goldilocks scenario. And I have spoken about this before, but the reason it's there, global growth is probably going to peak out in 2018. You've seen the IMF, the World Bank as well, upgrading their forecast for 2018. The US is now expected to grow at 3.2%. The Fed, although it is raising rates, is only expected to probably do 1.5 according to the market, even though they're forecasting 3. And Jerome Powell is only 2.5 weeks away from taking over, and he is clearly a little bit more dovish. US inflation, although it's there, it's certainly not rapidly running away. So the reason it's a Goldilocks scenario is that growth is on the up. They're a growth market, and you can already see with what's been going on in the Dow and the S&P all the way to pretty much 2018. They hit a record high. 26,116 was the close on Thursday, which is a really, really important number. The NASDAQ hit the highest level it's been since the dot-com bubble, which is an amazing scenario as well. They're all growth. All that hits in that growth story. The reason the Fed's interesting is because there's an idea that they could dither on raising rates. So the liquidity in the market that's been there since the GFC is likely to remain. And that is a good scenario with growth on the way up, all that kind of consumption picking up, etc. But the Federal Reserve not moving as fast as they could to take that liquidity away from the market is a positive thing for equities and a positive thing for markets. Inflation being that little bit lower also, again, just holds the line on that side. All of that feeds into a really positive story. The other side that you know that it's also happening in the US and why the US is a really interesting thing, and the macro side, is that China, for the first time in 2.5 years, is actually going to see its GDP go up. Although it's still expanding, it has been expanding about 6.5%, give or take. This is the first time in 2017 that their GDP has actually grown year on year. So it's going to be around 6.8, 6.9%. And that also shows you that they are picking up the slack, and in global growth, export nations and those that obviously provide some of the biggest consumerism products around, China, case in point, is all there. So the macro story is there. It therefore is a presenting top-down idea that growth stocks will do well, growth markets, so emerging markets, risk markets like China, are going to have a very interesting and likely positive year on the back of where we sit macro-wise.
And Australia, as we know, is so heavily tied up with China, and also what's really happening in the US economy with interest rates, because interest rates there are on the rise. We're also seeing moves in the bond market, and that's going to be interesting in terms of what that does, because China is heavily invested in US bonds, and they could get caught out by any slump in the bond market there.
Lots of parts to that question. Okay, let's have a look at that first. So let's look at an Australian-US relationship first. Another chart on screen is, for the first time in 19 years, sometime this year, the Federal Reserve will have a highest target band than the RBA cash rate. That will happen, because if you look at what's going on in Australia from our macro perspective, growth's okay, it's going quite along. We're going to have the best year of employment we've ever had in 2017, but wages are low, so inflation isn't really moving. So the ability for the RBA to move rates higher, which is obviously what everybody's forecasting, still looks quite a long way away. So it might happen this year. Personally, I don't think it will. If it did, it would probably be back end October, November, December, but again, unlikely. But the Fed will move at least once. So for the first time, as I said, in 19 years, the Fed rate will be probably around about 2.27%, and our rate will be, 1.5 to 1.75%. Our rate will be 1.5. The last time that happened, the Aussie dollar fell below 50 cents. So there is an interesting question that just gets back to your bond market question as well, because there is now this movement going on, and those of you that understand bonds, it can get quite technical, but what is currently going on in the bond market that is a little bit of a concern, and why the market is sort of ramping up, is that what they call front end of the curve, so things that are 2-year bonds or a year bonds, or you can even get bonds in the US that are as low as 3 months along, are getting interest rates on them that are almost the same, if not higher, and that's what they call an inversion curve, than the longer dated, so your 10 years, your 25, your 30 years. The catch with that is that it's obviously creates a liquidity issue in the short term. So if everybody starts going, well, hang on a minute, it's better to get value out in the longer term yield rather than the short term, they sell out at the front end of the curve and buy the back end. That's what they call the flattening. And that creates liquidity issues. And that's what we're talking about, is that there is a risk there that all of a sudden you can get this run on in credit markets, you can get all this sort of slight risk concern around it. And that's the very simple gist of what we're talking about. So that is the risk in the market, is that the Fed raises rates, the market freaks out, it moves out to the back end of the curve, short-term liquidity funding happens, and away we go. So that's a big point. I understand it's a bit sort of wishy-washy, but you need to be aware that the bond market movements are possibly also why the US dollar at the moment is quite weak. So although the Aussie dollar is sitting just shy of 80 cents, and that looks really interesting, it's actually, I would look at the euro dollar. Euro dollar's gone through 120. Have a look at dollar yen. It's going towards parity again. And that suggests that the US dollar weakness is actually a bit of a global thing, and people are questioning that bond market. The other part of your question was, okay, so with a growth market where we're going in an Australian-centric point of view, we did see it towards the back end of last year. So I think, again, you've got to have your beacon around China and around risk.
Yeah, well, let's talk about commodities too.
Yeah.
Yeah, in terms of what's likely to be happening there. There are forecasts that commodity prices will weaken off this year. What's your expectation there?
It will probably happen at the back end of the year. Again, though, looking at the macro overriding features with growth the way it is, commodities are still going to be quite strong. You've already seen that happening in copper. Copper hit $3.24, 25 a pound over in Chicago. It's been as high as just shy of 7,000 US dollars a ton on the LME, so in London. So copper is always your beacon for growth. It's why they call it Dr. Copper, and you've been seeing that filter through. The Chinese growth story, the European growth story in 2018 suggests that commodities will hold up. You will get fluctuations, and right now is one of them. So leading into Chinese Lunar New Year, the winter period in the Northern Hemisphere, the demand for iron ore tends to drop off a cliff, and you get this cyclicality point. So that might be when you do get that pullback. But if you look at what this year is looking like, it feels very replication of last year in terms of the periods, the growth story, the liquidity running around, the fact that China wants to soak it up, all the above. Commodities are there. 2019, I think is that question. 2019 will be different. You can feel that. Liquidity will run out of the market. The demand for commodities will fall away. The growth story is expected to slow down November, December this year. And that's when you can ask that question about whether or not the commodity story falls away. For the first 6 months, I'm still fairly comfortable and do believe that the commodities will have a fairly good run.
Well, this year started off really well, unlike previous years or more recent years. So it's positive from that aspect. It's just a matter of whether that momentum will keep continuing on the same course.
Exactly. And on that, just before we finish up, the interesting thing about the US story as well, because the other side, we're talking about all the economic stuff here. The other side here is the fiscal policy in the US. So we talked about in 2017 about what was coming with Trump's tax policy. And now we've seen it enacted at the back end, very last of 2017, and already in 2018, you've seen the market kick and the filter through. Very quickly to finish, you've already seen some of the biggest companies in the US move on that. So Apple has just announced that it will repatriate just shy of 200 billion US dollars from overseas. And the tax bill on that will be 38 billion. So it's just shy of 20%. You can see already that the growth profile for the US economy on the back of being able to bring money back into the country is there. They're not the only ones. Look at the big 5 banks. They now have tax rates roughly around 20% from 30. If you look at their big growth market industries, things like Clip Resources, etc., all of the same thing. So that's the other side of this. Is the other macro policy is tax in the US, and watch what that does to the US market.
That's a huge issue, and there's so many areas that are already seeing major pullbacks of capital and investment back into the US. So that's going to be a biggie. But we'll talk about that on an ongoing basis. Thanks again, Evan.
Thanks,
We'll leave it there. Thanks for joining us on The Economic View.